A common fallacy is that the rich don't pay taxes because they cheat. The truth is that the rich understand that if they invest their money in government-incentivized activities, they can get a lot richer and pay a lot less tax. Instead of vilifying their success, we can understand what makes them successful, even when it comes to taxes. Yet, most people hate taxes. Tom Wheelwright loves the subject and knows about taxes more than most CPAs and most government bureaucrats who work for the IRS. In his book, The Win-Win Wealth Strategy, he shows us how tax incentives combined with debt can be so great that they effectively fund most, if not all, of the investment. He presents to the reader 7 investments and activities the government wants you to engage in and the tax incentives they provide in exchange. We are excited to announce the launch of the Read and Grow podcast. Now you have one more medium where you can listen to your favorite book summaries. Subscribing to our show on Apple Podcast or Spotify would be greatly appreciated. Thank you. Like it or not, we are all partners with our government. We share a portion of our income in return for services provided. While it's not a voluntary partnership, it is one nonetheless. To win the game of taxes, you must understand the rules of the game. The object of the game is to build wealth that will never be taxed. The best path to building generational tax-free wealth is understanding how to best partner with the government. They know that much of what they want done is best accomplished by taxpayers, not by them. So they provide incentives to taxpayers to invest where they want the investments to be made and to accomplish what they want done. Every government has 5 primary goals: keep the peace, protect the people, feed the people, shelter the people, educate the people, which lead to the 7 primary investments incentivized by tax laws: business, technology, real estate, energy, agriculture, insurance, and retirement. Could the government take these projects on its own? Of course, but when they do it on their own, it's a bad investment. Taking on an investment internally would mean spending $1 and, at best, in return, receiving $1 worth of housing, energy, crops, or technology. Through tax incentives, however, the government can spend $1 on a tax credit, and in return, private builders will spend 9 of their own dollars. In this scenario, the government ends up with $10 worth of housing at a cost of $1. That's pretty smart, actually. Investment number 1. Business. Business tax incentives are available to every individual who decides to use them. They are not limited to big companies, technology startups, or other deep-pocket ventures. If you have ever considered starting a business, consider the difference in tax benefits between having a job and owning a business. It's significant. Here's a list of business tax incentives. 1. Deductions of current expenses. Any money you put back into your business is deductible against the income from your business. This includes payroll and employee benefits, rent, office supplies, and almost every expense that furthers the objectives of the business. 2. Capital expenditures. Businesses can deduct the cost of assets used in the business. For example, if a business purchases new manufacturing equipment, the cost of the equipment is deductible in the year it is purchased, even though the equipment may produce revenue over many years. 3. Lower tax rates. In most countries, entrepreneurs enjoy a lower tax rate for business income than for personal income, which makes business income a preferred source of income. 4. Accounting methods. A business has more control of the timing of the tax paid by its owners than an individual taxpayer. As long as the business continues to reinvest income, no tax is paid. And if the income is not distributed, only the business is taxed, not the owners. 5. Net operating losses. In most countries, a business can use losses from one year to offset income from another year. Investment number 2. Technology, research, and development. To encourage innovation, which is often very costly and produces more failures than successes, governments provide tax incentives to anyone willing to put their time, money, and energy into technological improvements. Incentive number 1. Deductions. While a normal business deduction is equal to $1 of deduction for every $1 spent, R&D deductions are often a multiple of the amount spent. Incentive number 2. Tax credits. They are even better than deductions because every dollar of tax credit offsets a dollar of tax liability. And here's the best part. It's not only new technological development that receives these tax benefits. What's rarely understood is that you can take deductions and credits for improvements in existing products or processes. Investment number 3, real estate. Of all the investments, real estate provides the greatest opportunity for strategic use of tax incentives to increase the real rate of return. Incentive number 1, deductions. In addition to business deductions, rental real estate gets a deduction that is reserved solely to the real estate industry, a depreciation deduction on appreciating assets. Normally, depreciation on real estate is taken over many years, considering the useful life of the building. But in the US, up to 30% of the depreciation can be taken in the first year of ownership, and this is true even if the purchase was financed by a bank. Incentive number 2, tax credits. Governments frequently target certain types of real estate development and incentivize them through tax credits. The US encourages construction and ownership of low-income housing, maintaining historical buildings, and providing access for the disabled. Incentive number 3, capital gains rates for selling real estate. Capital gains are gains earned from holding on to an investment for a long period of time, typically more than 1 year. Almost every country in the world has a lower tax rate for capital gains than for ordinary income. Incentive number 4, like-kind exchanges. Some countries, like the US, allow for a deferral of the gain from selling investment real estate if it's replaced with other real estate within a short period of time. Typically, the new property must cost more than the old one, and all the proceeds from the sale must be reinvested. The benefit of a like-kind exchange is that you can continue to invest in more valuable real estate and potentially enjoy higher cash flow without having to pay any taxes. Investment number 4, energy. It's clear that the world is on a mission to reduce emissions with clean energy. Investors and entrepreneurs will see massive tax deductions and credits over the next decade for implementing their government's energy policy. In the US, for example, there is a tax credit equal to 26% of the cost of installing solar panels for homeowners and businesses. In addition to that, there are also tax credits for installing electric vehicle charging stations, purchasing electric vehicles, installing energy-efficient windows and roofs, and building new energy-efficient homes. Investment number 5, agriculture. Farming, ranching, and other agricultural production can be a risky investment. In recognition of this and of the importance of successful agriculture to a nation's well-being, most countries allow specific tax benefits to offload some of the risk to the government. In fact, agricultural tax benefits are so great, they essentially offset the entire initial investment costs. Investment number 6, insurance. The life insurance industry serves to reduce dependence on the government for social services payments and is incentivized accordingly. Tax incentives for insurance include both typical incentives, such as deductions, as well as unique incentives, such as the non-taxable nature of life insurance proceeds and the non-taxable nature of investment earnings. Investment number 7, retirement savings. There are 2 types of retirement programs: qualified and non-qualified plans. Qualified plans are highly regulated by the government and allow specific tax benefits depending on whether the government's rules are followed. The primary benefit of a qualified plan, like the 401k, is the compounding of the earnings during the period when they are not subject to tax, and the avoidance of double taxation on earnings. In contrast, non-qualified plans are simply any plan an individual makes for retirement and come under the general rules for investment discussed previously, such as business, technology, real estate, agriculture, and energy. If you could invest tax-deferred outside of a qualified plan, you would always be better off, as you would have much more control over the investment. Reviewing the suggested investments, you've probably noticed the importance of debt as part of the tax strategy. This illustrates how important debt is to an economy and how much the government wants to encourage the use of debt. But debt should not be taken lightly. The purpose of debt is to acquire assets. The purpose of an asset is to create income. When the acquisition is fully funded by the government and the bank, all the risk remains in the operations. Becoming well-educated about the investment, understanding financial statements, and accurately projecting and managing cash flow is critical to the success of a debt-financed business. If you enjoyed this video, make sure to check our summary of another brilliant book by the same author, Tax-Free Wealth. Thank you for watching.